I'm going to be going over some basics of options trading, understanding just how to get started. So therefore you can make money in the stock market as well, because right now we are in a recession, and right now the market has been up and down. However, if you're holding long term, right, you have nothing to worry about. However, in the short term, right, with inflation being high and the cost of living and all that stuff, you want to be able to put yourself in a position where you can make money, right? And therefore, this is where options trading come in handy. So therefore, you can find ways to make money, right? And then options trading has made a huge difference in my life, allowing me to become a full-time trader since 2018, where I literally have been working for myself and started other business ventures because of options trading. So just wanted to kind of give it back and help others out as well, right? So thank you guys for jumping on, right? So what I was explaining right before that was, before you can do anything, the first thing you want to do, you want to make sure that you download a broker, right? And then there are a bunch of different brokers depending on where you are. So for example, in the US, you have TD Ameritrade, you have E-Trade, Fidelity, Schwab, Robinhood. There's a bunch that's out there. So download a broker if you're in the US. If you're in international, Interactive Broker is good. Trade Republic is another good one. IG is another good one. Plus 500 is another good one. And then there's a bunch more depending on the region that you live on, but internationally, those are some good ones. And then when you're opening up your account, you want to make sure you keep, there's going to be questions. There's like a questionnaire thing that you have to go through when you first get your account started in order to get certain qualifications to be able to trade in the beginning. So when you answer certain questions, you want to make sure that you're answering it in the way that it needs to be in order for you to be able to trade and do certain things with your account. And what I mean by that is, in the beginning, is they're going to ask you like level of experience, right? So you kind of want to answer those questions as if you already know what you're doing, because what's going to happen is, right, you're going to open your account and you're going to say you're a brand new beginner. You're going to be looked at as a high risk trader, a high risk account holder. So therefore, they're not going to give you certain qualifications. You're not going to be able to do the things that you need to do, right? So therefore, if you want to get in some calls, some puts, and different trades, you're not going to be able to do that because you're not going to have the permission to do that, because based on your level of experience, the broker does not feel confident to give you those permissions. So in the beginning, when you're filling out your application, make sure that you're answering as if you already have some level of experience, because it's going to be a lot easier for you just come back and study it or learn this stuff as I'm teaching you right now, versus having to keep reopening an account, right? And once you do that and you answer those questions, you'll get the permissions to be able to trade and do all that fun stuff. You want to decide between a margin or a cash account, right? So I'm going to explain the difference between the two, right? A margin account is when you have over $25,000, right? So everyone automatically, they're going to give you a margin account, but you want to choose a cash account, right? Because with the margin account, if you have over $25,000, what's going to happen is you're going to be able to get in and out of trades without any issues. However, with the margin account, right, it's money that you're borrowing. It comes with interest. You don't want to get yourself caught up where you're using the broker's money, right? So you want to use a cash account if your account is less than $25,000. If it's less than $25,000, you'll be able to get in and out of trades without any issues. But with a margins account, if your account is less than $25,000, you're going to get considered as a pattern day trader if you do more than 3 trades in a 5-day business period. So you want to make sure that your account is a cash account if it's under $25,000. In a margin account, if you're over $25,000, you have nothing to worry about. The only thing is with a cash account, you have to wait for that money to settle. So say if you get in a trade today and you make your money from the trade today, right? If you only have $1,000 and use all that $1,000 in that same day, what's going to happen is you have to wait until that clears the following day to reuse that money. But if you use $500 out of that $1,000, you'll have another $500 that you can use for other trades for the rest of the day, right? So just be mindful of that, right? And then fund your account and then you should be ready to start trading, right? So now, why would you want to trade stocks, right? Versus why would you want to trade options, trade stocks in general versus just buying and holding, right? Overall, what I like to tell everyone is you want to buy for the long term. Always invest for the long term, right? That's the long game. As much as I love options trading, as much money as I make options trading, the goal is to retire early, to not do anything, just to live the lifestyle that I want to, so I don't have to trade forever, so I don't have to do certain things. So you always want to invest for long term. And when you buy a stock, it gives you equitable interest in that company. So therefore, you are a part owner of that company because you're a shareholder of that publicly traded company. So therefore, you get a return on your investment when that stock goes up, right? So when the stock goes up, you get a return on your investment. However, right, if the stock is not going up from the price that you originally purchased it at, you're not going to be getting anything in return. You probably will be losing money if it's going down. And right now, right, if you didn't get in at a good price for certain stocks, what's going to happen right now as we're going through this recession, this up and down, this market right now, your account is probably in the red. However, one of the beauties when it comes to options trading, you can make money when the stock market is up or down, right? And you don't need to own that stock. When it comes to buying and holding for long-term, buying stocks, you have to be able to afford that stock. For example, right? So say if you take the S&P 500, right? The S&P 500 today was trading at $412, right? In order to get one share of the S&P 500, you have to be able to buy $412 worth of for that one share. But if you have $100 or $200, you can trade, you can make money off that stock. So you don't need to own that stock in order for you to make money from that stock, right? So that's one of the benefits. The other benefit is, right, you can make the money when the market is up or down, when that stock is up or down. It doesn't matter the direction of the stock, right? The next thing, right, you can make money as the market is going, as that stock is going down. I'm going to explain how you do that. And then you don't have to hold it for the long term. Primarily with stocks, you have to hold it for the long term. You have to hold it 5, 10, 15 years in order to maximize your return. Like the S&P 500, you're looking at 10, 15% annual return. However, I'm making 20, 30, 40% return in the same day. So therefore, you don't have to wait a whole year, 5 years, 10 years just to make a return on your money. Options trading allows you to do that. Right? So when it comes to options trading, you're going to have two different things you have to decide, right? Are you a day trader? Are you a swing trader? How do you want to trade? How do you want to make your money, right? Day trading is when you're trading, you're making that money in the same day, which is, I'm a day trader. I love day trading. Why? Because of the current climate that we're in right now, current market, I prefer to have more control, to be played on the safer side. So I'm considered a day trader. And a day trader is when you are getting into a trade, right? From, say, if 9:30 the market is open, say if you get in a trade at 9:30, if from 9:30 to 4 p.m., the time of the market closing, if I close my trade before the day is over, by the time the bell closes, I'm a day trader, right? It doesn't matter if you hold it 1 minute, 2 hours, 3 hours, 5 hours, excuse me. As long as you're trading within that day, you're getting in and you're getting out of that trade, right? Therefore, you're considered a day trader. For swing trading, if you're holding the trade for more than 24 hours, right? So that means overnight. So say if you get in a trade today at 9:30, right when the market opens, and then you didn't sell that trade, you didn't close that trade today, and you hold it and you close tomorrow when the market opens, that's considered day trading. That's considered swing trading because you're holding it overnight. However, there's a risk that comes with holding it overnight because, right, the market, anything can happen overnight. So like, for example, tomorrow we have the CPI report, right, which is inflation. So depending on what inflation is, so say if you had a call or say if you had a put, depending on what you have, depending on what the report shows, right, you're going to wake up either going to be very green or you're going to be very red. And the reason is because anything can happen. So that report will determine what happens to the market. So if you're a swing trader, there's a higher risk that comes along. Preferably, I like to get into a trade and be out of my trade within 10 minutes. So very rarely do you see me in a trade for like 30 minutes or an hour. I try to get in and out within 5 to 10 minutes because why? There's less risk associated. The longer you're in a trade, the longer you're in the market, the higher the risk, the higher the probability of you losing that trade because you're actively in there. And then you want to keep yourself, you want to give yourself the highest probability to win and to make money, right? So that's something you got to figure. Do you want to be a day trader? Do you want to be a swing trader? The positive to swing traders, right? If it goes your way, right? If it goes your way with swing trading, you're going to make a lot more money because, where'd it go? Sorry. If it goes your way with swing trading, right? If it goes your way, you have a higher potential for return in your investment. So therefore you'll make more money because you get a bigger move overnight versus day trading, right? Overnight, the market tends to move a lot more versus during the day. So there's the positive, the benefits that's there. So you just got to determine whether you want to swing trade or day trade. All right. So now that we've determined, all right, we're going to day trade or swing trade, right? You need to be able to understand what a call option is, right? And what a put option is. But first, let's go over a call option, right? So say if the S&P 500 today, let's use that again, right? S&P 500 is $412 today, right? So say if I'm thinking, I'm like, okay, the market today, right? I have a feeling it's going to go up, right? Regardless of technical analysis, I think the market is going to go up. So therefore, right, because I think the market is going to go up, right, I'm going to bet and place my money that the market is going to go up. So S&P 500 is trading at $412, $413. I'm going to buy calls that the S&P 500 is going to go up from the initial price. So the $412, $413 that it's at, me buying calls, that means I think the stock is going to go up, right? I make money as the stock goes up. So that's a call option, right? So again, when you think a stock is going up, you would buy a call. In the call, you make money, you make a profit as the stock price goes up, right? And then you make that profit. The higher that it goes, the more profit that you make, right? And then you'll have something that's called in the money, right? So, which is we'll go over a little further on the next couple of slides, which is if your strike price, once you reach your strike price, you'll have the option to exercise your contract. So, which is you'll be able to kind of get the stock, you'll be able to buy it at a lot cheaper. But overall, if you think the stock is going to go up, you play some calls because you know from one price, 412, right? You think it's going to go up to a higher, so therefore you buy some calls, right? And if you think the stock will go down, right, you play some puts. So puts is when you think the stock is going to go down. So S&P 500 again, right? It was trading at 413, 412 today, right? If I think the S&P 500 will go down to $400 or $405 from the 412 or 413, what I would do, I would buy some puts. So the puts, as the stock price goes down, right, I am making money. I am profiting in that, right? So you're making money as the stock price goes down. For calls, you make money when the stock price goes up. For puts, you make money when the stock price goes down. You're betting. So you're just taking your money, right? And you're betting that the price will go up. And then the way that this happens, right? It's an agreement. It's a financial contract between you and your broker. So this isn't done on paper. This is all you're doing is just hitting submit, and then boom, it's just an exchange. That's it. So, and that exchange is you buying that contract, which I'm going to explain how to read contracts and stuff like that in a little bit, right? That exchange is just you choosing to buy that contract at a specific price. And as that price goes down, you would make a profit, you would make money. And that's what pretty much the options trading right there. It's just an agreement between you and the broker, right? And then think of it this way, right? For every buyer, there's a seller. And for every seller, there's a buyer. So therefore, if you're buying something, there has to be somebody on the other side to receive it or to take it, and vice versa. And that's where trading volume and all that comes in handy. And then I'm going to explain that as well too in the upcoming slides. But yeah, so put options, the stock is going down. You make profit as the stock go down. And I'm going to show you guys some examples in a little bit of how to read it and stuff like that as well. Right. All right. So next, right, for calls and puts, right, you have to be able to understand the strike price, the expiration date, the contract, all those different things, right? First, let's start with the expiration date, right? So the expiration date, that's the last day that the contract is valid. And on the expiration date, you'll have three options you have to determine, right? One, you have to determine if you want to close and take profit or close for a loss, right? Two, you have to determine, right, if you want to allow your contract to expire worthless, 3, if you're in the money, you have to determine if you want to exercise your contract. So 3 option: let your contract expire worthless, take profit or a loss, or exercise your contract. 3 different things. And this is the last day. Primarily, you want to determine this before the expiration date because you have time decay, right? And if you don't determine that within enough time, what's going to happen is your contract is automatically going to expire worthless. Therefore, it would go to 0. So if you bought a contract that was cost $100 and the expiration date, for example, this week, right, Fridays, right, the expiration date in the market, if you notice, right, and I'll show you guys once I share the option chain on my screen, expiration dates go every Fridays, right, with the exception of the S&P 500, SPY, QQQ, the VIX, where they have different dates, but pretty much expiration dates, you'll look every Friday is an expiration date, right? So the expiration date, that's the day you have to determine if Friday for this week, for this week, the 17th is the expiration date. So therefore, by this Friday, I have to determine, say if I get in a trade, I have to determine, do I want to keep this trade for Friday, or do I want to let it expire worthless on Friday, or do I want to close it and take profit or exercise it? So you got 3 options to determine what you want to do with it, right? Next, matter of fact, how do you determine your expiration date, right? If you're a day trader, for me, something that I use as a day trader, you want to trade within that same week. And the reason why you want to trade, you want to use the expiration date within the same week is because of the volatility, because you have a higher probability to make your money if you're using that contract because it's moving faster because of time decay. It can work in your favor and it can work against you, right? Depending on if you're winning the trade or if you're losing the trade, right? So as a day trader, you want to keep it within that same week. When it gets closer towards that day, so like, for example, today is Monday. The contracts move differently on Mondays than they do on Fridays. So on Mondays, those are the days where I buy a little bit more contracts. Those are the days that I go a little bit more heavier. And the reason why is because I have more of a cushion versus the last day, which is the Friday, which would be 0 days to expiration. So being that I have a little bit more of a cushion, right? Therefore, my risk is more likely going to be less for today. Therefore, I'm going to be able to purchase a little bit more, knowing that the contracts are not moving with the same speed as they would be moving in that Friday. And the reason why on that Friday and the last day it would be moving faster is because of time decay, because it's in the last day. So therefore, it's going to be moving extremely fast. And then 2 things are going to happen. You're either going to be green really fast or red really fast, depending on, if you're winning or losing the trade, right? Next, we have the option premium, okay? When it comes to, right, reading out, picking or what to trade or like how to get into a contract, right? You want to be able to understand the premiums. The premiums are very important because if you don't understand it, you're going to put yourself in a bad situation because you want to be able to get the best contract possible, right? So the contract, you want to make sure that you're picking the best contract. And then all the option premium is the price that you're going to be paying for that contract. That's what the options premium are, right? And then the option premiums are the ask and the bid. The ask price is the lowest price that someone is willing to buy a share. And then the bid price is the lowest price that someone is willing to sell a share for the ask price. The bid price is the highest price someone is willing to buy a share. So what that means is, right, if you're trading, right, and then say if I send out a signal for example, I traded SPY today, right? So if I send out a signal for SPY, and SPY is currently the contract of SPY $410 strike, right? The contract is at $1.05. That's the ask price. And then the bid price is $1.10. If I'm buying at the ask, I'm going to get it at $1.05. If I'm buying at the bid, I'm going to pay more. It makes no sense for me to pay more for that contract when I can get it for cheaper. So you always want to buy at the ask versus the bid because you're primarily paying less. And some people, you can adjust the bid that you're selling it, right? And you have someone that will buy on the opposite side. When certain stocks are flying, when they're hot, people will just buy regardless of what it is. what would happen is the ask price would start to bump up. So say if your bid price was $1.09 and the ask was at 105 and that stock is just shooting up, what's going to happen is you're going to start to see the ask price go up to 109, 110. So it's going to start adjusting. So therefore you'd be trying to adjust your bid, right? However, if that stock flies, that contract flies higher than that price, you're not going to be able to enter that trade. So you would have to go back and readjust. So you want to make sure that you buy at the ask price because it'll automatically give you the lowest price to begin with, right? And then the bid price would be the highest price, so you just want to avoid it. Right? And if you're trying to sell your contract, right, you can sell at the bid. There's always somebody that's willing to buy at the higher price. However, it's going to take you a little bit longer to get a fill because somebody's primarily paying more to get into that contract, right? So I think I missed strike price. All right. So let me go back. Strike price. Your strike price is the most important value. It determines the value of the contract, right? Your strike price. So when it comes to the strike price, say if, let's use Apple, right? Apple is trading at right. So why would anyone buy your contract at the bid price? Right, because depending on if the stock is going great, right, there's always somebody that's willing. Just answer this quick question, because if the stock is going well, right, there's always somebody that's willing to buy because they're trying to get a fast fill, or they just don't understand. Certain brokers, if you don't make that adjustment, you will automatically just end up buying at the bid. I know Robinhood, some people adjusted on Robinhood. That's something that happens, and there's other brokers. So you just want to make sure that you're doing it for yourself at the ask price. All right, you guys can leave some questions here and I'll try to get through them at the end. All right, so back to the strike price, right? So the strike price, that determines the option's value. That's the most important thing when it comes to it, right? So the S&P 500, let's use the S&P 500 for example again, all right? So the S&P 500 is trading at $412. And say if I think the S&P 500 will go to $415, right? That strike price, that target, that's my strike price. So as it gets closer to it, right, if I'm buying a call, I'm making money. So that will determine the value of that contract. As it gets further away from it, that will determine if I'm losing money, right? So the strike price, that's the most important determining factor for you making money, right? And when it hits that strike price, so the 415, when it hits that strike price, what happens is you get to become in the money. So for call options, when the stock price is over the strike price, you are in the money. And then when you're in the money, you'll have the option to exercise your contract. And what that means is, right, say if you buy the S&P 500, you bought one contract, a call option at 98 cents or $98, right? And in that stock, the S&P 500 flies up, right? And that one contract does 100, like more than 100%. It's like at $300, right? You will have the option to actually buy the S&P 500 at a lower price at the $98. So you'll be able to get it cheaper, right? Because you're exercising your contract. So that's one of the benefits. So you can get the value worth from that. Right. And also that's a lot of CEOs, they do stock options for like bonuses and stuff like that versus being paid through cash. They do a lot of stock option. Why? Because they get it for cheaper and they'll exercise their contract later on. Right. So that's one of the benefits. When you're in the money, you can exercise your contract. For a put option, so say if the S&P 500 again is trading at 413, and for a put option, right, you're like, all right, my target is $410. So as that stock price goes down towards 410, and if it hits 410, therefore you're going to be in the money, you're making a profit, and you'll have the option to exercise your contract, right? So which kind of goes back to the different things you'll have before the expiration date. So the strike price is very important. Something to keep in mind when choosing your strike price, you don't want to just go very far out. What's going to happen is you're going to be out of the money. So that means when you're out of the money, the stock has to overperform just for you to be able to make some money. So therefore, the probability of you winning that trade, depending on your expiration date, it's going to be a lot lower, and you want to put yourself in a good position. So when you choose your strike price, right, you want to make sure that you choose your strike price for something that's reasonable, something that's attainable. So I'm not going to choose a strike price for the S&P 500 SPY for it to be $500 when SPY is trading at 410. It makes no sense. That means SPY has to go $90, and that's not happening. It's not happening today. You see what I mean? So therefore, you want to put yourself and give yourself the best chance to be able to make that money. So therefore, you want the strike price to be that something that's very attainable and reasonable. And if you need to go a little further out, what you want to do, that's when you want to go to the expiration date. Now you want the expiration date to be a little further out as well. So therefore, it can give you the time to be able to get there, right? So the expiration date, like for example, for day trading, right? I normally stick within that week, right? And then say if you want to do swing trade, if I'm doing a swing trade, right, for the following day or the day after, I normally go 2 weeks out. And the reason why I go 2 weeks out, because say if some bad news or something happens overnight, it gives the stock time to recover. It gives the stock a little bit of time. So therefore the premiums is not getting beat up too much, because I'm like, okay, cool. You know, I got 2 weeks for the stock to do what it needs to do. Right. It's just a bad news that happened. So therefore, it's a little bump in the road. However, because I have 2 weeks out or however long my expiration date is, therefore, I still have a chance of getting there. However, I'm not going 2 years out to get, to trade for 1 week. It doesn't make any sense, because the premiums are moving extremely slower. The further out you go, the slower the premiums move. The closer you are to the expiration date, the faster the premiums move. So you want to make sure that you keep that in mind, so you don't put yourself too far out of the money. So therefore, you're going to end up losing money, right? So that's the method to, like, every time I get into trade, making sure that it's a realistic price. So therefore, I know I always have the option, if need to take my profit if I'm in the money, or exercise my contract. And if I go too far out, I know I'm putting myself at risk automatically of losing with a higher probability. All right. Let's go into the next one. All right. So I'm going to just show you guys some examples of how to read some calls and some puts, just so you can see. I'm going to share my screen, a different screen, and you guys can let me know if you can see it. Okay. 1 second. Can you guys see my screen? Just give me a thumbs up, or just write something in there. Just want to make sure that you guys are seeing. Let's see. All right, so let's double check that. All right, perfect. All right, so this is the Discord, right? And I'm just going to show you how you guys can read that, right? So these are different contracts, right? So let's start with, for example, what's today? Today, right here, February 13th, right? So this morning, right, I sent out a signal, which was NVDA February 17th, $235 call at $1.12, right? So this right here, this is the ticker symbol, right? NVDA, right? February 17th, this is my expiration date, which is what I was saying in terms of I go at the end of the week. This is my strike price, $235. And then this is the call. And then right here, it just tells me the contract price. So this is what I would be paying for that contract, right? So something to keep in mind, the 112 here that you see, right? For example, I think I bought 11 contracts, right? So let's go, right? I think I bought 11 contracts right here, right? So you want, for every contract, you want to multiply it by 100. So one contract equals 100 shares. So therefore, if the contract price is, let's see, the contract price when I sent it out was at 112. So all you would do, you would multiply $1.12 times 100, right? $1.12 times 100. So therefore, that's $112, right? So $112, that's the true cost of that one contract, right? And then I bought 11 contracts. So for that contract, I paid, I think it was $12.30 or $12.32 for that contract, right? So as you guys can see right here, so this is how many contracts I bought, which was 11 contracts, right? And I made 13% off of it, right? I made $154. So therefore, out of $1,200, I made $154, right? So the contract, you multiply it by 100. One contract equals 100 shares. You multiply that by 100, right? And as you guys can see for the call, right here, 235. Let's see, what was it trading at? Just kind of show you how, if the realisticness of it. All right, I'm going to share my chart. Can you guys see the trading chart? Think or swim? All right, so this is NVDA. All right, great. All right, so this is NVDA. Right. So for example, let me just minimize this. All right, and I'm going to get to your questions in a little bit. So just type them in. As soon as we're done, I'll get through all of them. All right, so this is NVDA. All right, so I think NVDA was trading at 217, something like that. All right, so if you look, this is very attainable. So I did a $225 call. Today, NVDA reached $220, $221. All right, so I didn't choose something that was completely out of the realm, something that was completely unattainable. Right, and then when it comes to choosing my contracts, one of the biggest thing you want to look at is the volume. Right, so I'm going to show you. Let me share the other screen. I have a lot of different monitors in front of me, guys. So for every screen, I have to reshare. So bear with me. Let's see. All right, so right here. All right, so this is NVDA, right? And then with NVDA, right? So the way that you can pick out your contracts, right? Right now the market is closed, so the volume is not what it's represented. It's not accurate. So when the market opens, you'll see the accurate volume. So when you're picking out your contract, you want your contracts to be close to each other. Ideally, you want your spreads to be within 1 to 5 cents. 1 to 5 cents, you want your spreads to be. You don't want your spreads to be too far. And the reason is because the closer your spreads, the easier it is and the higher probability you have of winning that trade. The further out your spreads are, that means you would be starting to trade down. So say it right here. All right, you see there's a 77 cents, like you see 77 cents is the bid, and then 97 cents is the ask price, right? So 77 cents and then 97 cents. So what that means is you would be starting out the trade automatically down 26% right here, because the spread is so far down. So 77 cents and 97 cents. So that means as soon as you enter this trade, you're paying $97 for that one contract. As soon as you enter it, you automatically setting down, because now as soon as you sell it, you'd be selling it at $77. So that's a 26% loss. So you want to make sure that your spreads are close and tight to each other. If not, then you're going to putting yourself at risk of losing, right? And the stock would have to outperform. If it's starting the trade down this much, that means the stock would have to outperform in order for you to make money on that trade. So you want to make sure when you're getting into a trade, you want to look for favorable contracts that are within 1 to 5 cents. If you're going further out of the money when you're swing trading, then you can kind of go 5 to 10 cents. But when it comes to day trading, you want to keep it within that 5 cents, limit, unless there's a fantastic setup that you just can't pass up, that you know is guaranteed, which there's no guaranteed in the market. But you want to make sure that your spreads are tight. And over here, what we have is the calls on your left side. On the right side, we have the puts, and we have the ask and the bid price. Remember, always fill at the ask, never at the bid, right? And then you're always going to see the ask bigger than the bid on your platforms, because that's what you're paying for it. All right, you're always going to see it bigger, but that's fine, because when you're selling it, it's going to be different. When you're selling, is different. That's when somebody's paying for it versus, it's going to be different. So always buy at the ask, never at the. This is never going to be more than this. This is never going to be more than this. The bid is never going to be more than the ask on the actual option chain. But when you're selling it, which is going to be different. All right. So always buy at the ask and the bid. And in volume, you want to buy things that have high volume. Higher volume means that contract is going to be moving a lot faster. You want to buy things that are high volume because the contract is going to be moving a lot faster. Therefore, you have a higher probability of making money in that trade. There's a say if the stock is doing wonderful, right? However, there's not a lot of volume in that contract. The contract is not going to be, it's not going to represent how well the stock is moving. So you want to make sure that you get a good contract, because you could think, all right, this stock is doing phenomenal. This stock looked great. I know it's going to do wonderful, and it is doing wonderful. However, if it's not showing it in the contract, it's pointless, right? Because what's going to happen is you're going to put yourself in a situation where you're in these contracts and then you can't make money off the contract because the spreads are too far apart and it's not representing of that. And sometimes that happens when you have a lot of chop where the stock is doing well. No, you have a lot of chop. What happens is the premiums is getting burned up and down with every little bounce. So therefore you think, all right, the stock price is moving from 215. So say if the stock price was at $220 and it comes down to 215 and you're looking at the contract price, you're like, why is the contract not moving well? Why is the contract still down? And that's because there's not enough volume there, or because of the low volume, the bounces. So therefore the premiums are getting burned faster. Therefore you're losing the value of that contract. So you want to make sure that you put yourself in a good high probability setup to be able to win that trade. All right, so let's look at another example of another contract. Let me share it, a different screen. Let me share. All right, so let's look at another contract, right? So like Amazon, February, this was last week, right? So Amazon, all right, so let's just do something. Let's see. So we got, it was AMD, all right? AMD here. Right here, remember, this is the stock. This is the expiration date. This is the strike price. This is a call, tell you if it's a call put, and this is the contract, how much you'd be paying for it, right? And you'd multiply this by 100, that gives you the price, right? And then what I'm looking at, guys, this is just my Discord server. For those that's not members, you can have access to this. It's free. So once you click you guys, to be able to get this, you're already there already. So you guys already have access to all this stuff already. So all you have to do is just click the upgrade. Once you click the upgrade, what's going to happen is going to take you to this page. And then you can do a free trial and you can see it for yourself. I'll show you guys a quick trial, like what's happening in Discord, so you're able to see it. But very affordable. It's $39.95 a month. The first 7 days are free, and then after you have reoccurring monthly. Or if you want to save in the long run, you can do a yearly, which is you'll save $130, right? So let me just kind of go back. So something that I do in the Discord, for those who are not aware, I know some of our members might be on here as well, so they know of it, right? Every morning, right, before I get into any trade, before I do anything, the first thing that I do is I send out a watch list of what's happening for that day, what I'm looking to get into with the specific prices, then that I'm looking to target. So as you can see here, it's like, for example, NVDA, possible calls, right? I have the prices, I have everything set there already. So this is in the watch list before the market opens. And then once the market opens, so you already know the prices that I'm looking at, right? Before I get into these trades, I'm letting you know the contracts that I'm looking to enter, right? So automatically AMD, right? February 10th, $82. So therefore it gets you ready and prep for that trade. So therefore there's no reason why you can't make money with me if I'm letting you know what the trade I'm getting ready to get into. Like, so this gives you the prep. And then once you're prepping ready, once I see the stock is reaching my targets, then what I would do is I'll come in here and I'll send out the signal. So the signal, you already know what's coming. So all I'm doing is letting the signal go. Once I let the signal go, that means I'm entering it. You have the option to enter it with me. I've already given you the heads up. And then after that, I come in here, I give you a play-by-play of what's happening with the trade, and then boom. So like, for example, today, let's see, it took me 5 minutes in this trade, 9:55 to 10 a.m. I was out of the trade. So this was a 5-minute trade. All right, or 7 minutes, so a 9:53. All right, under 10 minutes, so in and out of the trade. So give you the heads up with the watch list of the stocks with the prices that I'm looking to enter and exit. And then I give you the contract price, the contracts that I'm looking at. And then after that, when I send out the signal, you know it, we both get in together, and then I literally walk you through it. So I literally hold your hands, like literally. I'm just going to quickly browse through. Losses do happen. Just want to show you guys, I had a bad loss. So this was 0 days to expiration. This was on Friday. This is what I was saying in terms of the options premiums move extremely fast. So I was actually up with this, and then it actually turned red because the options contract was just moving very fast. However, purchased less contracts because I knew that's what was going to happen. I knew because of the higher risk day. But if you look, my wins, I always make it bigger. Right here, 44% win prior to that. Right. So the wins are there. So a small loss, I keep it lower than, I try to keep it lower than 20%. So losses do happen. You guys get to see everything. I'm like an open book. All right. So let's see, this was more. This was another one right here. All right, let's go. All right, 33% here, 11%, 19% win, 33%, 30% win right here, 7%. Let's see, this one was 20% win. Keep going. 10%, 6% here, 13% win. This was a small percent, 9% loss. And then just keep going. All right. So there's a lot more wins than there are losses. 41% win. All right. So right now, my winning percentage is over 85%, as you guys can see, 45% here. And then the guys that's in the Discord, they know this. So this right here, I call QQQ on a simple, beautiful bear flag. So like quick strategy, I'm gonna show you guys. So bear flag is when you have a stock when it's dropping fast. What happens is it's gonna hit a support level. When it hit a support level, it's gonna start to move sideways. It's gonna start to consolidate. Once it breaks the support, expect a major move to the downside. And then this was right here. I caught it. All right. And then when catching this, I actually gave our members a specific heads up that I was looking at this specific play. I made 73% on that play. And then let's see more. So pretty much everything is in here. Had some losses as well, but the wins are always bigger, 20%, 12%. This was 11%, 16. All right. And it kind of goes up, right? 42%, 28%. And I can go like on forever and forever. So right here, 67%. All right. And I had 27% went right there. And then this one right here was a 98%. Let's take a look at how long this trade I was in, right? So 9:38 when I got into the trade. I was out of the trade by 9:45. So therefore it took me 7 minutes to make this. 7 minutes. All right. So in and out. So I like to be in and out, right? So I'm going to go back to sharing the other stuff that I was looking at. Again, guys, to get access to this, all you have to do is just when you click the upgrade, it'll take you to this page and here, and then you'll be able to kind of get access to all this stuff. So I'm going to reshare the other screen for you guys, break down some charts. Yeah, so let me share. All right. So how do we pick what stocks to trade, right? So when it comes to trading, you want to be able to give yourself the highest probability to win the trade. So therefore, in order to do that, you got to be able to pick the right stocks to trade. Something that you guys see, and for those that are in Discord, I have a certain set stocks that I like to trade. And the reason is because these are the stocks that I know that move with the highest volume, right? So it's very important that you trade stocks that have high volume. And what it is, trading volume is literally the amount of contract that's being exchanged between you and the seller. It's just, that's all it is. It's contracts being exchanged. So the more contracts, the more the volume that's available, that means there's more liquidity. More liquidity means higher probability, better order execution. Therefore, you'll be able to get in your trades and out of your trades a lot faster. So therefore, you want to be able to get into, you want to be able to trade stocks that have high volume so that you can get in and out of that trade faster. Because if you get in and you trade a stock that doesn't have high volume, what's going to happen is you're going to end up being pretty much asked out because the spreads are going to be too far apart. So therefore, you're going to be starting to trade significantly down and the stock has to outperform. Right. So when it comes to trading, you want to pick stocks that have high volume. And if you don't know what to trade, the easiest thing you can look at is big cap stocks, the Dow Jones Industrial 30, right? So these are the biggest 30 stocks that holds the top 30 stocks or whatever in the market, right? So these stocks are the stocks you want to look at. Or if all else fails, you just don't know what else. If you can't pick between those, look at the S&P 500. The S&P 500 always has high volume, or QQQ, which holds all the tech stocks. Let me just kind of show you the difference in the volumes, right? So you can see what I'm talking about. I'm going to share my screen again. So Right. So let's take a look at some different. So this is SPY. Take a look at SPY's option chain. As you can see here, there's the expiration date. There's a lot that's happening here, right? So you have a bunch of contracts, right? Now let's take a look at, let's do a meme stock. Let's do BlackBerry, right? BlackBerry. If you notice, it's not different. This is a big difference. There's not as many contracts available. So now let's take a look at the volume, right? If you look, the volume is significantly lower. So therefore, if you traded this today, these would be the only 2 contracts, right? Only 3 here you'd be able to get into. Only 3 contracts right here. That's it. There's just not enough volume. Same over here. If you look, not enough volume. So you want to trade stocks that have volume. So regardless how great this stock is, right? Because there's always a meme stock. There's always some stock that's out there that's just, you know, flying off the shelves. It's the new hot thing on TikTok, Instagram, Reddit, or any of those sites, right? If there's no volume, it doesn't matter how popular that stock is, because what's going to happen is you're not going to have any contracts to get in. It would make no sense to try to get into this stock right here, this trade right here, to buy this contract if there's no one to sell it to. In order for you to sell your contract, to get out of your contract, there needs to be somebody on the other side to receive that contract, to pay for it. So the volume, you want the volume to be there. You want high volumes, right? So let's take a look at QQQ, another one. This is one of my favorites, right? So look at how many, look at the options chain, right? Look at all these different contracts that's available, right? And if you look at the volume, huge difference, right? 69,000, 38,000. So that plays a major role, right? Plays a major role. Other things you can look at, as well, right? If you don't know what else to trade, right? Other stocks you can look at. I'm going to pull up the S&P 500 heat map, right? Right. So if you look, you want to look at the big guys, so like Microsoft, Apple, NVDA. These stocks, these are the stocks that move the market. Amazon, Tesla. These are the stocks that have the highest volume that move the market, right? And you want to be careful, because just because, another thing too, just because a stock is has high volume, no, just because a stock is has a high market value, a high market capitalization, doesn't mean it's optionable. Doesn't mean they have a lot of trading volume. So like, for example, CRM right here, Salesforce, right? And you, or even Johnson & Johnson, right? That stock is not optionable. There are stocks who are like big time stocks, but they're not optionable. That's something you have to consider as well. I'm just going to show you what I mean by that. I'm going to share a different screen. So I'm going to pull up Johnson & Johnson. If you look at Johnson & Johnson's contracts, they're trash. Look at this. They're trash. There's no volume there. So I would never trade this. Why? Because the contracts are trash. You want to be able to get something that have volume, something that you can make money. Granted, this is a big cap stock. So you want to make sure, you know, like just because it's a big cap, you want to make sure that it has some volume. All right. So there's a select few, just like CRM as well. Like I was saying, CRM, Salesforce, same thing. Volume is trash. Look at the spread difference. Right. So if right here, you'd be starting to trade down 8%, because the spread is 8 cents apart. That's 8%. That means, why am I going to start the trade down 8% automatically? All right. Makes no sense. Right. The open interest is just how many people are interested in your contract. So I don't go by that, because anybody can have an open interest. That doesn't mean, like, you want to go by the actual volume, because it's just the interest. It's not the actual what's actually happening. And the open interest, like, think of it like, hey, we have all these contracts prepped and ready. However, right, you have to be able to buy it. So just, these are all these contracts that I have ready, that's ready on the shelf, and just somebody has to buy it. So the open interest, that's what all it is. You want to go by the volume, not just by what the open interest is. Right. Let's see what else. All right. So last thing, I'm running out of time here. I'm going to show you guys how to read a chart real quickly. Let's share. All right. So when it comes to reading a chart, the simplest thing you can do, right? You want, well, not simplest. When you read a chart, you always want to read from left to right, read from left to right. That will tell you what's happening with the stock, right? That will tell you if the stock is profitable. If it's not profitable, all you have to do is just look at it from left to right, right? So let's stick with, let's see, excuse me. So we're going to start out, let's start out with the 10-year. All right, so we're going to start from left to right. So from left to right, we're going to draw a line, right? Is this stock where the current price is at now, right? Is it going up? You want the stock to be going up, right? You want the stock to be going up, right? So that tells you, okay, this stock is bullish. When it's going up, that means the stock is bullish. However, if you look, I'm looking at the 10-year mark. So if you're an investor, if you're a long-term investor, 10-year, right? And if you invested from here, then you would be making profits. But if you bought it when it was here, right now you're losing because it would be down here at 177 if you bought it at 197. So when you're looking at a chart, you want to determine if a stock is profitable. You want to read from left to right. You want to see if it's going up. As it's going up, that means it tells you if it's bullish. Same thing. This is going to be important when it comes to options trading because you have to be able to read the naked chart to tell, all right, is this right here bullish or bearish? Because that will let you know, okay, do I have a higher probability for calls or puts or not? All right. So let's take a look at SPY. Right, so let's take a look at SPY. So this is the S&P 500, right? Left to right, right? Bullish. As you can see, SPY always recovered, always goes up right here. Look at this trend line. And also, this is where it bounces off as well, too, off this trend. How ironic right here. You see this trend line right here? It just tells me right here. So two things going to happen tomorrow. It's going to break this trend line, right? It shoots up, depending on what the inflation number is, or what's going to happen is we're going to hit this trend line and we're going to come back down. As you guys can see right here, it rejected the trend line over here and then rejected the trend line again. All right, so just right here, so we'll determine. So right here, rejected it as well. So your trend line will act as support and resistance, but all right, when reading a stock, you want to read from left to right. If the stock is going from left to down, this tells you that the stock is bearish. Bullish is when the stock is going up. Bearish is when the stock is going down. All right, bullish, up, bearish, down. Right, and then when you're reading, right, when it comes to options trading, you want to, the way that you want to do it, you want to start out with the 1 year. If you're charting, you want to start out with the 1 year chart, right? From the 1 year chart, you want to see what patterns or what's happening, right? So draw a trend line from the highest point from left to right, all right, to the current, all right, right here, right? So it's, all right, look to see if there's any trend, do we see anything happening? So like, for example, before it got to that price, what was happening was it was rejecting right over here. So right here, I'm going to show you guys. All right, so before, this was a major rejection point right here. This was a major rejection point and it broke it. All right. So first thing, you want to look at the 1 year, draw a trend line to see what's happening, to see if there's anything that pops up, right? Once you draw a trend line, right, you want to mark some spots down where you see a resistance, right? So like, for example, at $407. So the next thing you would do, you go to the 4 hours to see if there's any similarities in the 4 hours, right? Draw a trend line as well. Look to see if you see any similarities. Once you're done with the 4 hours, then you come to the 1 hour. You want to look to see if there's some similarities as well. And then from there, you look at the 5 minute and then the 1 minute, right? And in the 5 minute and 1 minute, something that you'll see, this trend line that I draw from the 1 year, look at it. It also acted as a trend line today. It acted as a trend line today. Look at this, all right? You see that right here? So that right there, it tells you certain spots, certain resistance and supports. All right, let's see. All right, guys, I'm going to be getting off shortly. What questions do you have? How can we buy ETFs or think or swim and keep them for long term? And what's the benefit of having a Roth IRA account opposed to individual account? Okay. All right. So to buy an ETF, like for example, the S&P 500, that's an ETF. I'm just going to show you a simple way. Like, all right. So, well, all you would be doing is on your phone, you would just be going. Let me just see if I can share it. Hold on. Let's see here. Hold on. Let me see. right? So if you wanted to buy that stock, what you can do, you would just, I know on your phone you can do it a lot easier. Matter of fact, no, I'm sharing the wrong one. All right, so if you're on your computer, I'm using the computer, not my phone, so I'm gonna show from it. So if you right click, all you do is just click buy, and literally you buy the share right here. You'll be able to just kind of from your account right here. I'm not gonna buy anything now because the market is closed. No, do I want to like spend money in it right now? So, and you want to make sure that you just edit how much you're buying, because what a lot of brokers do, they will have certain prices, certain quantities in there. So you don't want to just end up buying 10 or 100 contracts without checking. All right. So, all you would do is just right click it and click on buy. You edit how many stocks or shares you want to get. And then boom, you hit confirm and send. That's how you buy it. Simple as that. And then if you're buying an options contract, all right, I'm just going to show you options contract. If you're on your computer, all you would do, you would come open up it. You type in whatever the stock is. All right, type in whatever the stock is, and then you go to the expiration date. And then from the expiration date, you look at for the strike price right here. And then with the strike price, you just click on it. Once you click on it, you want to edit how many contracts you want, and then you hit confirm and send. Right? It's that simple, right? So let's use another example, right? Let's see. I'm going to show you guys another example. Let's see here. Right. So for example, for this one, this was January 6, 2023. So like this was the expiration date. All right. Matter of fact, let's use today. Let's use the current one today. All right. So today's, let's see, scroll down. All right, so today was NVDA. I'm just going to show you guys how I got it. So NVDA February 17th, right? So I'm going to look for NVDA February 17th right here, $235 call. So what you would do, you would just simply just go to NVDA right here. I did the $235 call. So I look NVDA February 17th, expiration date, $235 call, scroll down, $235 call, and then click it. And then you just literally all you do is just put in how much you want to buy, hit confirm and send. All right, let's see what questions. All right, let's see what other questions you have. ETF. Also, what are the benefits of a Roth IRA account as opposed to an individual account? Right. So two things. A Roth IRA account, guys, I can talk all night. This is like my passion, by the way. I'm sure you guys probably figured this out. But yeah, so a Roth IRA account is just an individual retirement account. However, with the Roth IRA account, you can still invest with it, but you're limited. And what I mean by that is, right, you can't put in more than $7,000 for the year, I think 2022 or 2023. And then there's a limit based on how much you make for the year. So if you exceed, I think it's 145 or 155,000, you can't have a Roth IRA. However, it's just a retirement account. That retirement account you can't touch until 59 and a half years old. And if you touch it before then, you have to pay taxes on it. But the benefits of it is, right, it is tax free. If you hold it for at least 5 years and you're 59 and a half years old or over, then you get that money tax free. You don't have to pay taxes on it. All right. So that's what a Roth IRA is. However, there are limits. You can only invest, the maximum contribution is $7,000. It was at $6,600, but I think last year they increased it to $7,000. Right. And then say if you make more than that, if that's not enough, then you look at a SEP IRA. However, with an individual brokerage account, you can invest however amount you want, all up to you. You're not limited to the max contribution of $6,600 or $7,000. So you have a certain max that you can go up to. All right, I hope that answered your question. For options, what happens if the market has gone past your contract price, but you haven't sold the contract? Well, for that specific question, it all depending if say if it's a call, right? Let's go for a call, right? Matter of fact, I'm gonna just show you a quick example to answer your question. Let me share. So like, let's take NVDA, right? So NVDA today, right? I got into the call. Right now it's at $235, right? I got in the call, I got these $235, right? The contract price was at 112. Say if Friday comes, the February 17th, if I never sold it today, what happens is if I'm not in profit, if NVDA doesn't do well and I forget to close my contract, it's automatically going to exercise it for you if you're in the money. And if you're not in the money, it's going to expire worthless. So two things is going to happen. It will automatically exercise your contract for you if you're in the money. Something to keep in mind, it won't exercise it if you don't have that amount in your account. So that means if you have $100, therefore it's going to use that $100 as collateral, right? So it's going to exercise it. And then if you're losing that trade, it's going to expire worthless. Something to keep in mind, you don't lose more than you put in. So with this contract, $1.25, if this is $125 for that one contract, as it's showing right there, I don't lose more than $125. I do not lose more than that $125. However, I can make a lot more. I can make more than 100%. You don't lose more than you purchase. So as you can see, right? So looking to buy right here, right? And then let's go one contract, right? So one contract. So what happens, right? Confirm and send. So if you notice, it says max profit infinite, max loss $125. I do not lose more than $125. All right. And then all I would do is hit send. But right now the market is closed. I'm not looking to get into any trade. I hope that answered your question. What other questions you have? You sound legit, man. Hopefully I can join the Discord. Thank you. Thank you. Thank you. Yes, I am legit. This is not a scam. As you guys can see. Do you guys have any more questions? And also, guys, to get access to my Discord, let me just show you guys, for you guys that do have interest in joining the Discord. I'm just going to show you guys so you can see for yourself as well. And then something, once we get off this, for you guys, I ask one thing of you guys in the chat room, just leave some feedback if you enjoyed, if this was helpful for you guys, just leave it in here. All right, but let me show you guys the Discord. So for those that are just in here, you have access to the watch list that I send every morning for you, and that's free. I literally send you the watch list that I'm sending in here. So you have the exact watch list for every trade that I'm getting into. It's in here. It's just you have to be able to determine when to get in for yourself. And then you have the educational videos as well to kind of help you get started. And then these are just some testimonials. I've had the Discord for some time, since 2020. I started helping people. So this goes way back, way back. All right. And we had over like 10,000 people in it. Kind of got overwhelming. I had to minimize it. And then you have the free educational webinars, as you guys are on right now. Right. And then to upgrade it, like I was saying, all you have to do is you click the upgrade here. Once you click that, it's going to take you to this page. You get a 7-day free trial, and the monthly subscription is $39.95 a month. Very affordable. I'm not looking to, charge you an arm and a leg. Very affordable for what you're getting. You're getting the money back. We're very profitable. Right. There are losses that do come with this. I'm not one to hide my losses. Everything is in there so everyone can see. Yes, I win a lot of trades, but there are some losses that you guys can see. All right. And then, yeah, it's pretty much everything. So I'm going to get ready to log off. And if you guys have any last questions, just send me a message in the Discord. Just send me a message in the Discord. Just send me a direct message. And then just make sure to leave your feedback if this was helpful for you guys. So this will determine if I'll do another one. All right, guys. Last question while I go. What account size do you suggest starting with? So it all varies depending on your circumstance and your situation, because your circumstance and situation may vary from somebody else. So I'm never going to tell you for anything specifically. However, ideally, when you're starting out, $1,000, if you have a smaller account, it would be ideal, but you can get in trades that are less than that. So like, let me just show you real quickly. All right, let's see. So like, for example, right, if you can see right here, right? So say if you have $100, right? $100, you can still buy contracts, because you can see at a $245 call, this is 40 cents. That means you pay $40 to get into this trade, $40. So you can start with however much, depending on your circumstances. This is why options trading is awesome, because a bunch of different contract options right here. And then if you have $100,000, $10,000, then you can get some bigger contracts, right? Any more questions, or we're good? I hope that helped. I hope that answered. All right. Well, with that being said, guys, I actually went a little bit over, but I had fun explaining to you guys and helping. All right. And if you guys have anything else, just shoot me a message in the Discord, and I hope that you guys were able to learn and take some stuff away. And I look forward to seeing you guys in your trading journey. All right. So have a great evening, guys, and thank you for jumping on with me.